This last session is factor investing using value and momentum strategies. Delighted that we've got Ian Conway from Value Momentum here to talk us through his thoughts and explain how they do things. And then I'm sure we'll have time for some questions afterwards, and we'll wrap up, I would have thought, before 5 o'clock, and we'll have to go outside for the reception. But I'll hand over to Ian.
Daisy, thank you very much. Thanks so much for coming to the graveyard shift. As Daisy says, drinks won't be long. It's very interesting discussions today on macro and where markets might go as a result, and which assets we ought to be buying and so on. Hopefully this will dovetail with that and tell you what we think we ought to be buying, but from a bottom-up point of view. Factor investing, it's not new. It's a fancy phrase for what people have been doing for centuries, which is trying to work out what drives stock prices. 5 major factors: low beta. But 1970s it was worked out low beta could low and average price volatility could generate above average price returns. Size and value followed, and then quality and momentum. We are interested only in value and momentum. How do you establish value? It's extremely hard to establish a fair idea of value. This is, and if anybody can guess what it is, it's the South Sea Bubble Company. It's the South Sea Company, rather, in the 1720s. And in a nutshell, South Sea Company had a monopoly on trade with South America. Unfortunately, Spain had seized all its assets. We were at war with Spain in 1718, and the Spanish had seized all the company's assets, so it didn't actually have much trade with South America. But they kept issuing stock, they kept talking up the prospects for the company. And 1720s were quite interesting because this is a tail end of a period of very, very low price inflation in Europe. Food prices were falling, energy prices were falling, rents were falling, interest rates were falling, and there was a real dearth of good investments. Government bonds were yielding virtually nothing across Europe. So the prospect of great returns in South America, it wasn't hard to see why people fell for it. In fact, even Sir Isaac Newton invested in it. Famously sold out in April 1720. And said, I can calculate the motions of heavenly bodies, but I can't I think was his phrase exactly, but not the madness of people. And unfortunately, he then got sucked in towards the top and lost the equivalent of about £3.5 million in today's money. So even highly rational men like Sir Isaac Newton can get sucked in by extreme price moves and the promise of great riches. It's an extreme example, but it does show you, as I say, how quickly prices can move up and how quickly they can come down again. So the question is, I should mention, this is great. The client did say to me, maybe we should make a reference to cryptocurrencies at this point. I'm not an expert on cryptocurrencies, but at the same time the South Sea Company was operating, another company floated, literally. That was its proposition. That it had a great undertaking, and nobody was to know what it was about. This slide shows us how we approach valuation. The 2 factors, value and momentum. Starting point for us is always going to be value and valuation. We start with earnings, and Paul was on the panel with Simon earlier, and he explained we like to plot earnings back as far as we can. We actually have them going back to the 80s for Novo, but in this instance we just use 20 years, and the blue line is actual earnings, and the solid black line is what we think is the trend of earnings. As you can see, from 98 through to 2010, they're pretty much the same thing, so we weren't far off. Interesting thing happened then, from 2010-11 onwards, earnings started to diverge from the trend. And as a result, and you can see it there, investors and analysts started to factor in higher growth rates. Essentially, they thought there was a step change in the fortunes of the company, and Forecast started going out. Now, in fairness, you know, earnings were 30% above trend, so you can see why they might have thought that was reasonable. Once you've got your trend earnings line, then what you do is you divide it into the share price, and you get a trend PE for the stock. And we've lined these up as best we can. As you can see, nobody was paying a big premium for Novo. This is the mean. This is one standard deviation below, one above. And obviously we paid a lot for the stock back in 2000 because we paid a lot for everything, including pharma. It's been a long time at one standard deviation below, and then it's about the time that earnings were starting to rise above our trend here, so the ratings started to go up. And we were at, what, one standard deviation below come 2012. By the time we get to 2014, we're at 2 standard deviations above. We're over 30 times trend earnings. Unfortunately, there was no way that earnings were going to match the new forecasts that analysts were putting out. And at the same time, the share price went to 40 times trend earnings. So how did we know that earnings weren't going to get there? Well, what we do every month is we gather, and as Paul's explained, we gather earnings forecasts for about 5,000 companies around the world. And we've been doing this for 20 years or so. And what we're interested in is 12-month blended estimates going forwards. So today, we're taking 10 months of 2018, 2 months of 2019, and we're looking at where those forecasts are and the growth rate compared with the growth rate that was being assumed 1 month ago, 3 months ago, and 6 months ago. And what was happening was, actually, if I go back, analysts start, the growth rate they were factoring in, they started to rein back on that come 2015, 2016. And that was important because what we're measuring here is this rate of change. So we're not interested in the growth per se, we're interested in how that growth forecast compares with the growth forecast a month ago, 3 months ago, 6 months ago. And it was slowing down, but at the same time, the valuation had gone to the levels we'd last paid in the bubble. So for us, this was a warning sign. And here we have, and if anybody else was at the asset allocation presentation this morning, but each of these bars is 1 month, and this is the last 3 years of earnings revisions for Novo Nordisk. And what we do is we take the earnings revision, it's a percentage number, and then we rank each company against the average of the market. Green bar is above the average, yellow bar is below the average. And you can see coming into 16, it was starting to fade slightly, still pretty good, but it was starting to fade slightly, and that is when analysts started to row back on their forecast. They were still upgrading, but they weren't upgrading with as much fervour as they had previously. And you've got a bit of a grace period here, where even coming into July 2016, the revisions were quite clearly going, and yet the share price carried on going. Simon used a good phrase this morning, persistence. Investors typically tend to hold on to stocks that have been very good to them for a long time, just as they tend to dismiss stocks that have been bad to them. And you were talking about the huge, underweight in certain sectors earlier. This is really, really interesting. As I say, unfortunately, didn't get us very far because nobody was really interested in selling it out at that point. But in all the years we've been doing this, that combination very rarely ends well. And of course, August 2016, the company's guidance disappointed. And it was a pretty spectacular derating. You went from 40 times to just over 20 times in just about 6 months. 6 to 9 months. So that shows you, again, there we go, little box to show that there was a time there when we were explaining to people why they ought to be paying attention, why they ought to be aware at least of this slowdown in the rate of upgrades for Novo. Unfortunately, people weren't terribly interested. What's also interesting is that you see the revisions have started to recover, and as they've started to recover, so has the relative share price. So for me, jury's out still on Novo. It's cheap. It has been cheaper. Does it have to spend time below the mean? Is the question I would ask. I suspect it does, at least unless these bars start to improve here and the momentum starts to improve. On a happier note, and I've combined two in one here, roughly the same time that we were talking about Novo and saying take money off the table, we'd noticed this. I'm going to pick up here, almost imperceptible, but the valuation was so low in ArcelorMittal that we were looking at it because typically if a stock gets to below 5 times trend earnings, one or two things happens. It either goes bust or it doesn't. And given that it had been almost bust back in the early 2000s on trend earnings, earnings were very cyclically depressed. They were very cyclically depressed in 2016. But we have the inverse here. We have analysts downgrading. Obviously, this is after the China wobble of 2015, so everybody thought, well, better cut our forecast again for Asian exposed stocks. And the pace of downgrade started to slow, and it's so slight that you barely notice it. But that inflection point is really important. That's a positive change in the rate of change, whereas Novo was a negative change in the rate of change. The price started to move, valuation was in place, and then we started to get really, really strong revision bars. But actually, again, unfortunately, nobody was terribly interested. Even value investors that we spoke to didn't think it was the time to be buying cyclicals. In fact, it's not alone. It wasn't alone. And if you see in your handouts, page 11, I don't know if you can see them in this light. One of the things with this methodology is we've got 5,000 stocks under coverage. We can look across markets, we can look across sectors, and if we see more stocks moving like this, the more interested we are. Page 11, you've got what we call our Asian exposure basket. So there's a European basket and there's a US basket. These are simply companies with a large proportion of profits and revenues from Asia. We have a Latin American exposure basket, we have a US exposure basket for European stocks. They'd started to, from US underperforming, Europe just performing in line, they started to pick up. Something, was moving, price was moving for a lot of stocks at the same time with the same thematic. And that gave us more confidence that Arcelor, was not only cheap, but actually was probably going to turn out to be quite a good trade. As it happened, it was. This chart, I think actually Paul probably started off with this one, in the asset allocation one. This shows you can actually have several bites of the cherry in the same stock. Again, we can see here how 2016, same time as Arcelor, that was a good time to be looking at it. But go back to 2008, the crisis. If you'd owned it from any point really, probably before 2006, even if you hadn't got out in 2007, if you'd sold it in 2008, it was coming down through one standard deviation, bought it back, going back up through one standard deviation below, sold it again one standard deviation above, been a lot better than a buy and hold strategy. And it's quite a nice chart because you can see that although it doesn't spend a lot of time at the middle, it does mean revert. So as well as doing this for individual stocks, as I mentioned, we have baskets of stocks, and one of the things we're asked about most often is if revisions do drive stock prices, then what would happen if I bought a basket of stocks, only a basket of stocks that had above average revisions? Would it beat the market? And it does beat the market. Every quarter, we screen our European stock database. We've got 1,500 stocks, 1,600 stocks, Michael. And we look for those with 2 years of consistently above average or green bars. As long as they've got above average bars for 2 years, they go into the basket. And they stay in the basket for that quarter until they, each quarter until they stop having above average bars. Typically, we have 50 stocks, I would say, in that basket out of 1,600. That's a very small number of stocks that can do that. They're equally weighted, and every quarter gets rebalanced. That doesn't include rebalancing costs, but it's not a bad CAGR. We do it for the US. Again, better return than S&P, higher volatility, and it works globally as well. And this we're using the MSCI World as a benchmark, but actually the stocks come out of the S&P Global 1800. We have an Australian milk company in there. A few growth investors might know what that is. We have Hong Kong pharma companies. We have Greek cosmetic companies that make the grade. This is one of the most fascinating things actually about this exercise, is it points you to companies that otherwise you wouldn't even have considered. The other interesting thing about this is that typically, if you look at most global funds, I'd say the top 10 holdings, the ones that are beating the market, the top 10, 12 holdings are typically the same names. I think we know what they are. With this, and that's where the performance is coming from. There's quite a degree of skew. In fact, there's a degree of skew in markets. I'll digress very briefly. Paper by Henrik Bessenbinder from Arizona State University. 2016, he studied the returns of every stock quoted in the US from 1926 to 2016. That's over 25,000 stocks. And he included everything that was either taken over or went to zero. Because it's interesting because most studies only include stocks which are still quoted today. So there's a lot of survivor bias. He found that excess returns over 1 month treasuries, paper was entitled Do Stocks Outperform Treasuries? And he found that the proportion of stocks that generated the excess return was incredibly small. I thought it would be about 20%. It's 3 to 4% of stocks account for all the excess return over treasuries over that 90-year period if you just bought and held them. Shocking statistic is that the most frequent return on stocks was zero. And I don't mean you got your money back, I mean you lost everything. The stock actually went to zero. Out of 25,000 stocks, the most frequent return was zero. So we are also in the global basket, as we are in the European and the US basket. We are, the methodology is picking 3 to 4% of the market, but it's not picking all the same names everybody else is picking, which is really interesting. And typically 70% of stocks are beating the market each quarter. So even though we've got a very small selection, there isn't a huge degree of skew within that. The flip side is the worst bars basket. I haven't got a chart of the worst bars basket, but it's hitting relative lows. Each of the worst bars baskets are hitting relative lows. They are they're stocks to just leave to one side. If you're a long-short investor, they may be a good idea of sort of long-term short ideas. Unfortunately, a rising market, you're not going to make an absolute return on them. You'll just lag the benchmark, But what's possibly more interesting, and here we go, this is the last slide, it is the last slide, is I mentioned that with our best bars baskets, you have to make the grade. Every quarter it's assessed. Every quarter, if a stock doesn't make the grade, it gets booted out. And there's no discussion, there's no special pleading. Novo was one, Provident Financial was one, Intrum Justitia was one, Inditex was one, and Atos was one. Other, the Rogues Gallery, Christian Hansen, Criteo, Pandora, Vestas, Signet, and this just gets you away from that scenario of Novo, of the stock's fantastic must-own growth stock, and I don't care about the revisions or the valuation. Typically, if a stock has been in the best bars basket for some time, it's going to be expensive. So for those that are sort of very into their factors, obviously there's a sort of value element to it, and it's not buying cheap stocks. They will tend to be expensive. Therefore, when revisions start to deteriorate, you really have to take notice, as in the case of Novo. I would flag, I made a little list here, Campari. So when we did the last review at the beginning of January, Campari came out, Brembo came out, Remy came out, which is quite interesting because they're all expensive. In the US, we lost McDonald's, we lost Home Depot, and Constellation Brands bars don't look terribly good either. That's been a terrific performer for a staple. Very finally, lots of discussion, Simon, about tech, US tech stocks. I can tell you that a couple of them look like they're going to leave the basket. We've got Align Technology, which has just been absolutely stellar, especially over the last 12 months, and Arista Networks. That doesn't mean it's time to give up on US tech, and as the chap from Ned Davis was saying, these trends will persist. We don't know how long they're going to persist, but we are aware that A, they're not cheap, and B, revisions are starting to go in US semiconductors. That's partly a factor of the tax changes and the fact that, again, I don't have the slide, but Paul had the slide before in the asset allocation discussion, partly a factor of the average US revision to forecast is now 12%, and even for Go-Go Semis, that's going some, and they're not particularly favoured by the tax changes. But also the fact that we're talking law of big numbers now, and these things are not getting the upgrades that they were. So keep an eye on US technology, I would say. And I think that's about it, if anybody's got any questions.
Now, what have we done with the microphone? Here we go. Come round. It's quite heavy. I don't want to... We've managed to get through the day without any injuries so far.
Thanks very much. My question is, can you use this kind of work to aggregate the data to get a country or regional perspective on value and momentum?
Yes. Can't give you a... we can't give you a country revision as such, because you'd have to compare the country. These are relative to whatever your universe is. So we couldn't do Italy versus Europe. But we can do, in terms of revisions, we can do an Italian trend PE, for sure. We've got Italian trend PE. US, Europe, Japan, all the European markets, we have trend PE charts for. And one of the things we do is, as I mentioned with Novo, 2000 we paid 45 trend earnings, 2001. 45 times trend earnings. When you look at the market valuation at the time, that doesn't particularly stand out. So we can look at the valuation of Novo sort of divided by the valuation of the market, and we can say, okay, relative to the market, I mean, in absolute terms, it was nuts paying 45 times for Novo in 2001. However, we were paying 45 times for utilities when National Grid was going to stick the internet down the power lines and so on, that was considered a tech stock. So when you look at it relative to the market, that barely features. This, on the other hand, is a huge, huge outlier. It's very, very clear that this was the wrong price for it. So yes, we can do countries, and we can do sectors. We can do sectors, US, Europe, UK, working on Asia and Japan.
There was another question. Do you want to just hand it to the chap behind you? Okay, thank you.
Yeah, hi. So going back to the screening for your value factor, and you said
Yes.
20 years normalised earnings, which is
Yeah.
but there's not a whole load of stocks. You exclude quite a few stocks with
Mm.
that history. So
I know.
do you get a sort of age bias, if you like, and does that help? Do you find?
It's
Yeah.
interesting you ask. I was talking with Andy Hartwell, who was the moderator on the panel, and he was saying he's been working on 10-year cyclically adjusted numbers, and he's getting very good R-squared numbers for future returns from that. It was a conscious decision. I mean, we still have about 1,800 companies in our global sort of valuation universe. Mike, how many have we got in Europe now? 700? Yeah. Over 700. Got pretty much S&P X the FANG type stocks. So yes, it's very difficult. I missed the Amazon presentation. One of the things that I was looking at a long time back was how the growth rates changed, and wondering, do you have two different growth rates for the early period and then the later period, because it's obviously settled down to a particular growth rate now that's no way similar to the early growth rate when Amazon was mopping up everything. So we can do shorter term growth rates. We do shorter term revisions, and it's typically when people ask us on a bespoke basis, we can do that. What did you have in mind, sort of stock-wise?
Well, I was just thinking if you use 20 years of data, then you exclude. I mean, sometimes I don't know what the research finds, but I think if you just pick stocks with a long-term history, just picking those stocks, and in the long run, might outperform than picking the whole universe.
Yeah.
So you exclude kind of like the tech stocks that are just sort of IPO'd in.
I know. I mean, there are a number, but we have. I'm talking about globals, for instance, talking about on a global basis and global funds. Tencent, been around longer than you realise. I mean, because we've got Tencent in there. I mean, we can go back 15 years. 15 years. We were looking at SES, weren't we, Mike? And that goes back to 94. So.
As long as the earnings history isn't too erratic, as long as you can trend it with a decent level of confidence, then you need to have realistically 15 years gives you a very good idea of what it's going to grow like over time. But obviously, if you're a restart Joe and you're going up video, then it's very hard to model that going forwards.
So, but you would have to exclude a certain percentage of stocks because.
Yeah, I mean, Novo's unusual. It's a nice, predictable growth rate, which is why we thought that people were getting a bit ahead of themselves when their earnings were above trend. But were they going to? Was this a step change? We didn't think so. A lot of them are very volatile. I mean, Arcelor, you can imagine it's not a 17% grower, that's for sure, because quite often the earnings go a long way below the trend. If the slope of earnings is like that, we just give up with it. But if something comes out and the earnings are flying around, we're slightly less interested in it. Once they settle down, and that only happens over time, once the growth rate's kind of normalised, then we'll look at them. But we've got 1,800, which is a reasonable amount for us at the moment.
I was thinking like stocks like Unilever are very predictable, so you tend to favour those kind of stocks in the sense that they're.
No, I mean that's
in terms of ease.
Ease of use.
Yeah.
No, I'm with you. But we're always open to, as I say, we were looking at SES on the basis that it's in the worst bars basket and it's been an absolute dog. But the earnings trend is actually not too bad. You can actually get a trend line through the earnings. It hasn't made whoop. It's not Alcatel. It hasn't gone up and then just gone straight through the floor. So we actually developed an earnings trend for this week for SES and thought, that's quite interesting. And then it had numbers and it went down, but then it closed up and it's been going up each day since, thinking there's a value case maybe for SES. So whenever people say to us, have you got this, have you got that, has it got enough, we're always happy to look at it. It's certainly not fixed. We're always happy to look at new stocks.
And sorry, the second question is,
Yeah.
what was the name of that paper again, 2016?
Chap's name's Henrik Bessenbinder.
Henrik Bessenbinder. Okay.
Henrik Bessenbinder, Arizona State University, and it's do stocks outperform treasuries.
Okay, great.
And he's just looking at the excess return over 1 month treasuries, monthly. Fascinating.
Thank you.
Any more from any more? There we go, Lars.
It's fine, I don't think the mic.
No,
Thank you for the presentation. It
Thank
seems
you.
that you consider the two factors when you're looking at individual stocks.
Mm.
There can be a value case, even if the earnings revision momentum isn't perhaps quite there, there's a margin of safety because of the valuation.
Mm.
When it comes to constructing the baskets, are you essentially valuation agnostic? You really look
yeah.
at it, and that's why it
Yeah.
seems that they outperform over time, but the volatility is higher, I suppose, because A, there are fewer constituents, and B, if they're on the expensive side, if there is a broader pullback,
Yes.
then the extent of
Yeah.
multiple compression will be
Yeah.
pronounced in
Yeah.
your particular basket.
Yeah, absolutely. And that's why it's so crucial when something leaves the basket, we flag it to people, and it's what you own that can hurt you. And Novo was a case in point. Inditex was another one, and we were saying to people, but these stocks have been good to people for quite a long time, and they don't want to kick them out because it's sort of, well, what do I own instead? Not only go and buy Hennes and Moritz. Do I trust Next or Hugo Boss, or you have to go down the sort of quality scale if you're going to replace an Inditex with something else, and what do you do with that cash? That's why I think you get this grace period, and it's the persistence that Simon was talking about, until it's actually demonstrated to people that something's gone wrong. And with Novo, we weren't saying there's anything wrong with it. We were just simply saying that the rate of change of the pace of upgrades had slowed down, and that there was an investment risk in being in the thing. It took a while, but we're seeing a lot more, and I think this is going to be particularly relevant going forward. Obviously, volatility is going up. That selling the volatility baskets, that trade's over now. But we're seeing a lot more in Europe. Stocks getting hammered for missing. Now that used to be just the US phenomenon. You'd see stock down 15, 20%, you'd think, oh, blimey. That's happening more and more in Europe now as well. So it's forewarned is forearmed, in our view.
There was another question,
Sorry.
wasn't there? And then
It's value as a factor, just value alone.
Mm.
As a sensational record, that's the 33rd
Mm.
record of the last decade. Is there anything in your work that can explain why that's been the case and whether that might change?
No, I mean, we don't have, I must admit, we haven't got anything sort of really, really long term. It's not a timing tool. So yeah, Novo, you could have spent, well, actually, at any point here, it's sort of, it's taking you a very long time to see any kind of return on that stock. Which is why we, where are we? Which is why we would wait to see some sort of movement in the revision. So analysts getting less bearish than they were. And it's relative to the market, which is another, I guess, twist, because we're tending to look at stuff on a relative basis. So relative to the market, was that a good, well, we know it wasn't a great idea to stay long. Was it a good idea to buy? Well, relatively speaking, yes. But with the stocks, for instance, the stuff in the best and the worst bars basket is, I mean, it's cheap. It's really cheap. Telefonica. Do you want to buy Telefonica? I would think not until it's thrown at least 3 or 6, above average bars at you, because in sectors, I mean, it's an extremely unloved sector, and people aren't going to take good news at face value. It's going to be a very long process for people to think, yeah, this is great. Unless we're talking, from a relative point of view, there is a major rotation because people get very worried about rates going up. And then everybody does have to put money into defensive stocks. But without an improvement in revision bars, we would tend to just let sleeping dogs lie, to be honest, I would say.
Yeah, question.
Sleeping dogs didn't have to. When I used to run these style factors in a previous life, we used to spend a lot of time. Well, it's a two-part question. One, we looked at the envelope, so we looked at the dispersion of estimates. Do you do that? Question one. And question two, the other, we sort of gave up on estimate revisions as a style because when you really, really needed it, what happened was the price went south, and then everybody cut their estimates. And again, the price went up, and everybody put their estimates. So actually, estimates are a lagging indicator, not a leading indicator. So how do you answer those 2 points?
Firstly, sorry, remind me of the first point. Sorry,
The standard deviation.
Oh, the standard deviation of estimates.
Dispersion
Of estimates, okay. We have the information, but we don't use the information. What we do use is the volatility of earnings around the trend. That's always interesting. But it's not quite the same thing, but I take your point. I mean, typically, if you have, and that's actually a byproduct, where are we? Dispersion of estimates is going to be a product of the volatility of historic earnings. So if you have a company that earnings just track along what we think the trend is, and there's very little volatility, then Air Liquide's a classic case in point, or actually Unilever used to be the classic case in point, that there was very little volatility of earnings around the trend. That makes life quite easy for management and for analysts to kind of forecast where they're going to be in 2, 3, 4 years' time. With cyclicals, it's extremely difficult. So you would typically, obviously, as you can imagine, get a lot of dispersion of estimates in cyclicals, much less in the staples and that sort of thing. And your second question?
The lagging.
Lagging versus leading indicator.
Well, not always, and in particular, not when stocks have been very good to people. I mean, just from our experience.
So remind me, this is the first derivative or the second?
Second derivative, so it's the rate of change of the rate of change, yeah. I mean, we weren't panicking here at all, nobody. But here, especially when it was on 40 times trend earnings. At that point, we were saying to people, listen, there's nothing wrong with it, and we're not saying it's gone ex-growth, heaven forbid, but is it worth 40 times when analysts are quite clearly now rowing back on their growth forecasts? Because they got far too carried away in 2015, because earnings were 30% above trend. But it's normal, as we were discussing before, there's sort of they factor in this sort of step change in estimates, and it turns out not to be the case. But I do take your point. That we were actually discussing this previously with somebody, that tends to be a symptom of lack of communication between companies and analysts. So if the company's sitting on a dark secret and they reveal it, the share price gets hammered, then the forecasts come down. There's not a lot we can do about that. But I'd say that tends to be the minority of cases, at least in our experience. It's more this, or very, very cheap, lots of green bars, nobody paying attention to it. Tends to be the way it works.
Any more for any more? Or shall we call time, literally? Ian, thank you. That was really, really interesting. And I think,
Thank you.
judging on the ratio of questions to audience size, it was more like a round table discussion. It was fantastic to really have a proper dialogue. So I applaud you for your questions and involvement. And let's
Daisy.
applaud Ian.
Thank you very much.